The stock market fell today, and why? Because the manufacturing data looked bad. But what else is new? We've seen that industry going further and further into the ground for decades. But whenever you zoom out and you look on a global level, you're going to see the same issue. Weakness persists. Now, since we've seen the most massive monetary experiments in history with global QE, the stock markets have benefited from devalued currencies. But the truth is that the divide between the real economy and the fake markets cannot persist. We're in for a wild one. You came here for the truth, so let me unveil that for you. Today we're going to look at what is happening within the real economy. I'm going to give you an update on what's going on with the repos, and I'm going to cover some other factors that I do believe are integral to understand right now at this time, so let's begin. You can see the markets here, of course, on the right-hand side. The sea of red is persistent, but this is one day of many days in the green. As soon as we went into QE4, as soon as the central banks decided that this was the new round of monetary easing, the stock market has been heading in one direction. If I go like this with the month or the 3-month and beyond, we see the same thing happening. Obviously, the markets have truly benefited from this quantitative easing. There is no doubt. Now, we're going to look at some of the details about the quantitative easing in just a second, but let's begin by taking a look at the manufacturing data that was relevant to this trading day in particular. A key manufacturing index shows the US remains in contraction territory. It was at 48.1 in November, and that's the ISM specifically. So when you go below 50, that is a contraction. If you look at other indicators though, they have come up, and I'll show you those in just a second. If you see what the Wall Street Journal had written, manufacturing's lingering malaise. The backdrop seems better for American manufacturers, but until the data show actual improvement, caution is warranted. And I don't know what kind of data they're pulling up here. They're not explaining it, that's for sure, in this article. But if you look at the information that I have shown you in previous videos, it doesn't look very strong at all. It doesn't look like we have underlying foundation that is healthy, but they try to bring it up as if it is. You could see this manufacturing new orders index. It has been going down for basically 2 years now. If you tell me that this is starting to look good, I don't see it, at least in this particular indicator. Then we have this, which shows you the market PMI, the ISM PMIs, and there is a big difference between these two right now. Generally, they would move together. We do see variances as time goes on, but as you can see, the blue line being the market PMIs, which have actually come up beyond 50, so that is no longer in contraction, and then we see the ISM data, which is continuing to move down. But in general, what we have seen since 2018 is that they had moved down significantly. We will see where the trend goes. It is not looking good on many levels. We see that with South Korea's exports. We look at a lot of the data coming from all over the world, and it's pointing in the same direction. Then we have this, the ISM new orders as well as employment, and these have been going down just like with what I just showed you from 2018 into 2019, essentially for the last 2 years, moving in sync with each other. This is just more data piling up on top, and connected in with that is the November ISM composite PMI. If you look below that, we're getting the orders, the employments, everything is moving down. This is showing us basically from what looks like probably the year 2000 or so, all the way up until present. And you could see the same behavior over and over again, where we are watching these markets, this data rather, as well as all of the information that has piled up, and you see it looking very weak. There's no way to put that otherwise when you see it all. If you just look at the stock market, for instance, yes, you get one picture. Overall, if you look at it on the month, if you look at it on the year, you're going to see the positivity. But I want to see the data and how it is broken down. I want to make sense of it for myself. I know that the stock market can go in one direction, but I'm looking at the actual economy and how it affects people. If you have, a good percentage of these individuals that are supposedly employed, but really they're Uber drivers, Uber Eats drivers, they're working 3 hours a month, yet they are counting for the supposed employed individuals, that group of people, that doesn't really count in my book. Yes, it technically is some form of employment, but my goodness, we shouldn't be counting them in there. There has to be some repurposing of what we had seen previously in the calculations. Anyway, manufacturing at a glance, November 2019. If you look at this here, it is broken down entirely, and this just gives you a better look at the ISM information, and you don't see one piece of data. You're going to see 48.1. That's not enough. You want to see this broken down, specifically looking at the new orders, the production, the employment, the supplier deliveries, and so on. There is only one factor in here that is actually looking bad, but not in a contraction, and that is this right here. Supplier deliveries is in fact slowing. However, it's the only one that isn't contracting. I mean, it's unbelievable to see all of these really adding up. So it's not just a fluke what we've seen with the ISM. This is a trend, and that is very clear, based on all of these factors, as well as the fact that this has been going back since 2018 up until now. JP Morgan's global manufacturing PMI has actually gone into the positive territory. It is still rather weak, but you can see that it has changed somewhat. If you see what had happened over the previous, let's say, year and a half, it was weakening and weakening and weakening, and now it has turned up somewhat. Now, this has to do with trade optimism. There hasn't been any actual trade optimism, but in the news, that's been pushed out there, and largely that's what this is based on, not on anything actually fundamental, but that's the way this world works today. It is completely upside down, so that's that. And you can see the global GDP versus equities. And there's a big difference. Global GDP versus equities, and you can see a big difference in between the two, quite a disparity here. And they're showing the percentage of the global GDP growth, which is the red line, at 1.99%. Now, I'm not sure where they're getting these numbers from exactly, but it just remains to be seen that the MSCI All Country World Index and the S&P 500 and the NASDAQ and so on, these have moved up while the GDP growth has slowed. Whatever number it is doesn't really matter. I'm just showing you the trends here, and it is very clear to me that we have this problem specifically because of what they have done. They've tried to print money in order to fix the problem. They tried to reduce interest rates, and of course that doesn't work. Never has and never will. Now we're looking at the QE specifically. This happens to be the New York Fed adding liquidity amid heavy demand for year-end funding, something that they said would not be a problem, but I had stressed that in a previous video that of course it would be a problem. And this is specifically what I was talking about in that other video, suggesting to you that there's a couple opportunities before the end of the year for this to move into 2020. And they said that, oh no, it's not going to be an issue. We've got it down packed. Don't worry about it. This has already been taken care of. They said that in the articles, as well as the Federal Reserve and others. But of course, they lie to us every single time. Not sure why anybody still believes them. This is the New York Fed website where you can see the consistent demand for the liquidity that the Federal Reserve is injecting. This is a chart that is associated with that. And it is seemingly between $60 and $80 billion a day, at least what we see publicly here. Although the Federal Reserve themselves had suggested throughout October, they were pumping in $190 billion a day. So I'm not sure what the calculation is on that, but at least with the overnight operations, that's between 60 and 80 billion rather consistently since mid to late October or so. We'll see what happens in the future. Corporate debt. Now, this is one that I wanted to squeeze in here. Definitely, I think is really important. I don't think it's being stressed enough. I do believe that there are major cracks in the corporate debt market. Now, this right here shows you a number. Corporate debt nears a record $10 trillion, and borrowing binge poses new risks. Okay, so we have that. This article breaks it down. Definitely check this one out and the next one if you want to know more about that. However, in this Forbes article, they calculate this quite differently, and I wanted to explain this to you. Total corporate debt is much higher than the 10 trillion, adding the debt of small, medium-sized enterprises, family businesses, and other businesses which are not listed in stock exchanges adds another $5.5 trillion. In other words, total U.S. corporate debt is $15.5 trillion. That is 74% of U.S. GDP. And that is a big issue that cannot be resolved simply by pumping up liquidity into the system on a daily basis. That's what we're talking about here. Sometimes my delivery isn't very good, not very strong, but I try to pull this all together and we can see what has happened. We have the markets moving in one direction, we have the economy moving in another. We have debt piling up and we have deficits growing at a rate we have never seen before. All the while, we see people that are pushing themselves to the absolute edge. The risk is being taken on every single level. When you look at it on the personal level, when you look at it on the corporations, on the national level, and of course we see this all around. That is unsustainable, and eventually we have an issue that could pop up in the corporate sector, that could be derivatives, it could happen within the stock market or the bond market, it could be real estate. I really don't know, but we're looking at all of this and it's adding up and not in a good way. I'm going to end the video there. If you found it informative, hit the thumbs up button. By clicking one button, you support this channel, so I do appreciate that very much. If you want to build a business online, if you're interested in passive income, if you just want to know about e-commerce, then I have a free e-course that is available to all of my subscribers. So if you're a subscriber, check out the AmazonGPS.com. If you want to learn about the financial system, the foundation, the history, the asset classes, how to make money, and everything else to do with money, check out my 2 books. They are located in the description of this video if you want the audiobook that's available at themoneygps.com. Wait a second, hold on. Have you seen this video? I think it's really important. It's 60 seconds long and it breaks down exactly what I've been trying to tell everybody for so long. Click on it and I will see you there.